Okay. Aditi, shall we start?
Yes, ma'am.
Yeah, please go ahead.
So, good morning, everyone. On behalf of the Department of Economics, I deem it an honor to welcome you all to today's expert masterclass. And today with us, we have Dr. Lekha Chakraborty. She is a professor at the National Institute of Public Finance and Policy at Delhi. She is also a research affiliate at the Levy Economics Institute of Bard College in New York. And she is also a member in the governing board of management, International Institute of Public Finance. It is a World Association of Public Finance Economics in Munich. So, over to you, ma'am.
Thank you. Thank you so much. Is it clear, my voice?
Yes, ma'am, you're clear, ma'am. You're audible.
Thank you. And good morning. It's my second homecoming. So the next time I hope to be in person with you on campus. And thank you so much, Sugantha ma'am, for asking me to speak to the students on the monetary policy responses globally to the growing uncertainties. This morning, I would like to ask you the question: what is the effectiveness of monetary policy in arresting the macroeconomic uncertainty and volatility that has happened after the pandemic? And we are also going through the geopolitical uncertainties and energy price crisis. So what is the role of monetary policy in reducing this macroeconomic volatility and uncertainty? So when I speak about this uncertainty, it's uncertainty about both inflation and output, because inflation is mounting. In many countries, we have seen that, there is a process of stagflation happening. And there is a lot of debate in India whether there is stagflation or not. But, output gaps, that is very crucial to look into. Then, the good news is that in the Western world, not exactly maybe in the emerging economies, these macroeconomic volatility in inflation and output is showing a declining trend. So these are good signs, but we need to understand what is the role of monetary policy, in doing this moderation after the great pandemic. So that's what we need to look into. So we know that many center banks took up this fight against inflation in the earlier decades also. And, they have done it successfully by anchoring the inflationary expectations properly. So in this process, many countries have gone through the process of a rules-based monetary macroeconomics. That rules-based is they design an inflation targeting, and a solid nominal anchor of inflation was, designed in many countries. So by design of the policy perspectives or the policy prescriptions, by design, ours is not a discretionary monetary economics, but more or less a rules-based monetary economics. So that design is very important to look into. Now, with the advance of the inflation targeting around the world in many countries, we try to tackle the inflation. And, this is especially after the global financial crisis of 2008. We have started giving a lot of importance to the monetary policy stance. And we thought that the monetary policy stance through inflation targeting channel will be able to absorb this macroeconomic uncertainties and volatilities. But you need to understand that monetary policy was partial in its outcome, in the sense, excuse me, it was partial in its outcome in the sense, the rate of interest, that is the predominant policy tool of monetary policy, the policy rates. But, despite decreasing the, policy rates, we have reached even a liquidity trap in many countries. The growth recovery process that was not that, quick as it would have been, had fiscal policy dominance be on board. So what we have lost during that decade after the global financial crisis was we have not given enough significance to the fiscal policy. But right now, in the pandemic time, we have given enough importance to the redominance of fiscal policy stance. So that fiscal policy, monetary policy coordination is very crucial when you have energy price volatility and your policy rates are to a certain extent, it's partial in its impact on outcomes. So that's what we need to tackle right now. Now, what is a tangible risk? The tangible risk is the persistence of the shocks hitting our economy. And those tangible risks we need to look into through how we design the economic growth framework. And, many economists argue that by design, you have to look into the business cycles, and fiscal policy and monetary policy can act as counter-cyclical policy tools to absorb those shocks and uncertainties. But by design, if you're not incorporating the high hysteresis into the economic growth model, then you may be erring on the side of caution, and you may be erring because this dip or drop in the economic growth process in the pandemic period or in the economic crisis period may not be cyclical, but it could be a permanent scar. So the design, what is the design of the policy, we need to look into to understand the policy prescriptions. And if we continue to date the business cycles and frame, the economic policy design as counter-cyclical, then we may run into trouble. So that's why we need to look into this macroeconomic uncertainties from a hysteresis perspective. And Noopur, your student, your classmate, she sent me a note on inflation targeting and what are her perspectives on inflation containment with her colleague, with her classmate, and I enjoyed reading that aspects, and I am yet to deliver that note back to Noopur with my solid comments. But what I appreciate is she has understood correctly how the macroeconomic policy tools in the monetary front needs to be applied judiciously to tackle both the output gap volatility and the inflation volatility. And in this pandemic era or the post-pandemic era, and after this war in Ukraine, there is a kind of unexpected increase in this macroeconomic volatility, both in terms of the output growth and in terms of the inflation. So here, there is always a trade-off when it comes to the central bank, because if they are focusing on the output growth volatility, and if they have to, focus on the growth outcomes, economic growth outcomes, then, the policy narrative is that we need to keep the policy rates lower. But there is a trade-off over there, because with the mounting inflation, we need to increase the interest rate to tackle this inflationary, tendencies in the economy. And now, to complicate this process, in the Jackson Hole meetings a day before or 2 days before, there was Jackson Hole meetings. And in that Jackson Hole meetings, there is more or less a broad consensus that the monetary policy needs to look into, inflation containment. And then they also realize that if they are focusing on the growth process, it could be potentially, inconsistent in nature. In the sense, you need to keep the interest rate lower to support the growth recovery process. But if you're doing that, then with the mounting inflation, you will not be able to tackle that, and you will not be able to go back to the nominal inflation anchor you have designed for your economy. Nominal inflation anchor is different in US, in India, in European Union. In India, the nominal anchor of inflation is 4%, and we have the band plus or minus 2. But in US, their ultimate aim of the monetary policy stance, and Jay Powell has clearly mentioned that we need to go back to 2%. So the question is there any terminal policy rate that we can front load right now and work towards that? And if you ask me what could be that terminal rate of the policy rates, up to which point we can increase the policy rates right now, I don't want to take a guess on that, but it could be even higher than the prior pandemic rates. So we don't know. We have to wait and watch, because in the MPC meetings, in the Monetary Policy Committee meetings, after that, when the Monetary Committee members and Reserve Bank governor, when they interacted with press, to the journalists also, they didn't commit any terminal interest rate that up to which, what is that upper bound of the policy rates. But it has got its own negatives and positives, in the sense, if you increase the policy rates, if the monetary policy transmission is complete, then you can increase the financialization of savings, because for the financialization of savings, what you require is high interest rates. Because otherwise, with the negative interest rates, in the sense, the nominal interest rate is around, now 4 to 5%, even, we are grappling around 5%, but inflation is mounting beyond comfort zone, and comfort zone is 4 plus 2, 6. And now if you look into, yeah, tell me.
I'm sorry to interrupt, ma'am.
Yeah.
Ma'am, it's quite fast. And could you please slow it down a bit, ma'am? We are not able to catch up.
Okay. Thank you so much. I'll do that. Yeah, sure. What I was trying to mention is negative interest rates. Negative interest rate is nominal interest rate minus inflation. And nominal interest rate is, around 4 to 5, even grappling around 5%. Let's assume that. And now the inflation is mounting above the comfort zone, that is 6%, because the nominal inflation anchor is 4 plus 2, 6. So with the policy rates 5 and with the mounting inflation above 7, nominal interest rate minus inflation, that we are getting into a negative real interest rate. And negative real interest rate is a matter of concern. And if you have negative real interest rates, then, the financialization of savings, when you look into, for instance, from the layman's perspective, I can tell you, we deposit in our term deposits in the bank, right? So negative interest rate is you are not even getting what you deposited in the bank. So that's negative interest rate. Or if our parents put their money in the pension bond market, then, if the interest rates are negative, they are not even getting back the money they have deposited. And, many $1 trillion in the economy across the world, they are in the negative interest rate quadrant. And I hope that point is very clear. So the dilemma which I was trying to make you understand is this. On one side, we need to keep the interest rate lower for the growth recovery process. But on the other hand, we need to increase the interest rate because we need to tackle the mounting inflation. And also we need to tackle, the decline in the financialization of savings, because we have to confront negative real interest rates. And also, in the Jackson Hole meetings, we can know the narrative that they are going to increase the interest rates. And if the US is going to increase the interest rates in a series, that will affect the emerging economies, in the sense, in the emerging economies, the capital will become flighty, the foreign capital, that a component of our BOP, it's not FDI, it is FPI, foreign portfolio investment. And foreign direct investment is multinational, and that's the little bit stable foreign capital. But in the foreign portfolio investment, especially the hot money component of the foreign capital, that becomes flighty when the interest rate of the Western world go up, because hot money always respond to the high interest rates, and they will try to move to the countries in which the interest rates are higher. So to prevent that, we need to increase the interest rate. So you can understand the dilemma. A moment you close your eyes and imagine you are on that hot seat. You are the RBI governor. What you will do? In Nopus, that note, in the beautiful note, she has given me her thought process. But, students, you can think about it. We will increase the interest rate or not. And if we go hawkish in the sense, if we increase the interest rate, of course, we can tackle many issues, like we can avoid the capital flight to a certain extent because our interest rates are also equally attractive. Then we can prevent the plummeting financialization of savings, and we can tackle mounting inflation. But on the other hand, if the interest rate is higher, then how do you respond to the growth recovery process? For the growth recovery process, the inflation, the interest rates needs to be lower because the credit need to be, cheaper. Your loans need to be cheaper so that you can take credit and you can take the loans and you can invest. And when the investment goes up, then that will help in the economic growth recovery. But savings are also equally important. So you can understand that. The importance of even increasing the interest rates. But if you look into the central bank narrative in India, we have not yet spoken about a neutral policy stance. We only mentioned that it's a withdrawal from the accommodative phase because we cannot go back to normalization by focusing on fiscal and monetary policy stance away from being accommodative. Then what will happen to the economic growth recovery process? So when monetary policy is supporting inflation, it's a role of fiscal policy to absorb this volatility in the output, in the outcomes. In the sense, we need to increase the interest rates. We need to increase the public debt and deficit so that they can support the growth recovery process through enough expenditure programs. Otherwise, in the times of revenue uncertainties, tax buoyancy is not great. Then if you are focusing on expenditure compression to keep the fiscal policy back to the normalization path, then that can affect the growth recovery process. And to add to this complication, even in the Jackson Hole meetings, it was understood or it was acknowledged that the climate change is a major driver of this macroeconomic volatility. So the policies, the macroeconomic policies from the monetary macro front needs to focus on the climate change, concerns as well, because extreme or disruptive weather events that's rising sharply. You have seen the sea rise in your own state, your own place. So there are a lot of issues related to the climate change, and we need to tackle that and using the monetary and fiscal policy tools, because we cannot now remain that the climate change is not a cup of tea of the monetary policy stance, because the climate change related risk and uncertainties are started affecting the output and also this inflationary process. It's both mitigation and adaptation components of climate change policies needs to be given adequate importance to tackle this volatility in the growth or in the output and in the inflation. So, these are very important because earlier, prior to the pandemic, there was a rise in protectionism around the world. In the sense, with using the tariff and non-tariff barriers, China, US, during the Trump's regime, there was a rise in the globalization, so the rise in the retreat of globalization, rise in protectionism. That's what I meant. And that has affected the global supply chains. And after this pandemic, we are trying to tackle the supply side shocks and the inflationary potential that's coming from the disruption of the global supply chains. There, the protectionism can go little adverse in the process. So we need to focus on globalization. There is no retreat from globalization to contain the supply side shocks, because the volatility or the disruptions that has happened through, this breaks in the global supply chains also led to mounting inflation. That is supply side, inflation. So using this monetary policy framework, the supply side shocks, how we can manage in the inflation targeting, that's a crucial question. But we do anchor the inflationary expectations that's coming from even the supply side shocks. So that's a way. So through the tariff and non-tariff barriers, if you try to undermine the benefits of a free trade, then we are running into trouble. So it's kind of a policy coordination is very crucial for the monetary policy, framework to be, effective. Otherwise, the economies are very fragile after going through this pandemic and the geopolitical uncertainty. So here, the alarming forms of protectionism can add to those dangers. So we need to understand that we cannot do that, because on the monetary policy front, if they have to increase the interest rate, then the growth recovery process needs to be supported by the fiscal policy stance. But fiscal policy stance need to be focusing on many components other than economic growth per se, because we have overcome a pandemic. So we need to focus on the food security, on social infrastructure policies in education and health, and we need to focus on social protection, because inflation hurts the poor people the most. So we need to continue with the social protection process from the fiscal policy front. And also it can prevent civil war if you do a food protectionism, because many economies have seen civil war and social unrest, because they are dying out of hunger. They don't have the role of the state didn't give enough importance to food protectionism. But in our country, we have seen in many subnational governments, the food security, the food protectionism was one of the important components of the pandemic packages. So these are very important. Then you have seen what has happened in Sri Lanka, but it will not happen in India, because in India, the external debt component is very insignificant. We are focusing on internal debt management and the use of the fiscal space. There is a huge debate now on the freebies, but there is no consensus regarding what exactly is a freebie. But if you design the fiscal policy based on the unsustainable policies to attract the voters' mandate by providing them the privateness of the public goods, then we are running into trouble. But in the freebies debate, what we need to understand, the role of fiscal policy is to provide primarily the non-rival and non-excludable public goods. So there we need to focus the role of the state. And also, if the externality, if you look into externalities in the sense, the social return, that should be greater than the private return. So the state can also invest in those, goods. Those are called merit goods. So that's the role of the state. So for that, we need to keep the fiscal policy stance very accommodative. Green transition or just transition is very crucial. And in that process, there is a huge bargaining that's happening, in the sense emerging countries do face energy price volatility and energy poverty. So in this bargaining process with the Western world, if they are asking us to reduce the fossil fuel in this energy transition, we will suffer, because our fossil fuel, that just transition from the fossil fuel to the non-fossil fuel, we need time. And in terms of the energy consumption, our consumption is very negligible when compared to the Western world. But when it comes to the policies and when it comes to, what needs to be done, the Western world is asking the emerging economies and the developing economies to work with the fossil fuel economy. But that question is closely related to the energy crisis and the energy poverty we face in the developing countries. So the monetary policy and the fiscal policy stance, when they do the greening, the transition, then we have to be extremely careful in our narrative that how we are going to do the just transition to the green technologies. And here, there is a dilemma for the monetary policy stance. And there is a political economy when you distinguish between green bonds and the brown bonds. And can you go political if you are a central bank chief or a central bank governor by distinguishing the investments based on green and brown bonds? This is a question raised by Rikuram Rajan, and that's valid. And many people or also questioning the, the toolkits available with the monetary policy stance to tackle the green transition or to the greening the monetary policy. There, lack of toolkits can be an insufficient argument because these instabilities, volatilities of the climate change, risk and uncertainties can affect the financial stability also. So for the financial stability, that's one of the prime concerns of our monetary policy stance. And for that, we need to focus on greening the monetary policy. And there is no way out. And European Central Bank has focused on a stress test. They have asked the top investors and the banks to undergo stress test and what is the impact of the climate change risk and uncertainties on their financial decisions and the financial stability. And RBI is open to greening the monetary policy. We have seen many chapters in the State of Economy report and the RBI bulletin. So we are open to that. But in MPC meetings, maybe in the next meeting, we may be able to understand a clear adaptation communication from the monetary policy front. Because in India, for the first time, country is preparing the national adaptation communication from the fiscal policy front. I'm a part of that national adaptation communication, that what you call the commission. And from the fiscal policy front, we are doing enough and hope the monetary policy in the next MPC meeting will come up with a very clear climate change related policy prescription. Because in the Jackson Hole meetings also, the takeaway it was given by Geeta Gopinath immediately after the meeting. It's there in the Twitter, you can take a look into that. She did a 1-minute video on the takeaways of Jackson Hole meeting in US, which gives you primarily the monetary policy narrative of US government. So there she mentioned that there is a broad consensus that the monetary policy across the world needs to be focusing on inflation containment. And there is, of course, a trade-off with the growth outcomes. And second, what she mentioned is about the climate change risk and uncertainties, the mitigation and adaptation that we cannot delay right now because of macroeconomic volatility is happening mostly or it is happening in a high frequency from the climate change related uncertainties and events, and that is on rise. And the final takeaway is how this policies needs to be coordinated, how the policies needs to be accommodative, mutually coordinating, so that we will get a stable growth recovery process and we will be able to contain this global inflation which is mounting to an effective level. Thank you. Now I will take your questions. Over to you, Professor Suganta, ma'am. And thank you so much, to the School of Economics, Coimbatore, for having me. It's always a pleasure to talk to your brilliant students, and I look forward to your questions. Thank you.
Yeah, I think Ma'am Nupur has some questions.
Yes, go ahead. I will listen to the questions and come in the end because we have 10 minutes now. Okay, let me listen to the questions.
Good morning, ma'am. Nupur here.
Yeah.
Ma'am, so I have a doubt. Like, since you were mentioning that we need to accommodate climate change in our monetary policies. So, since even in the budget this year, they had mentioned that we'll be transitioning towards the green infrastructure. So, we'll be allocating budget towards that. So, since if we are investing more in the green infrastructure for now, so we need to spend on the infrastructure as such, and the returns will be in the future. So, will that not affect the growth rate of India? At the same time, will it not create a new inflation cycle in India? That was my question, ma'am.
Oh, that's brilliant. Thank you so much. Any other questions?
Ma'am, and also like in UK, so for
Yeah.
transitioning towards the renewable sources of energy, they have made this point that any institution which is providing electricity or they're providing the fossil fuels, they have made it compulsory that this 10 they there's a minimum percentage, like for 10% or 15% has to be a renewable source. So if such kind of policies are implemented in India, how far is it going to be effective? And the policies which are in set
forth already in India, how much is that contributing towards the climate change? Because if we see even in the like abroad, even in the European countries, they had mentioned that they will be investing a lot in green infrastructure. But recently there was some news that they had declared natural gas as a renewable energy. So how far are we actually on the stance of moving towards the climate change?
Oh, good question. Thank you. Yes, go ahead.
These are my questions for now, ma'am. If there is anything, I'll ask you later, ma'am.
Oh, sure, Nupur. Your friends have any questions?
Good morning, ma'am. I'm Amrita.
Yeah.
As per the news article, recently India has reached the fifth position in terms of world's largest economy, overtaking UK.
Hmm.
The major reason is due to the domestic production in India have developed. Adding point on, no, I mean, adding my connecting my point with Nupur's first point. What if we are changing into, I mean, like we are promoting green infrastructure, and what would be the reasons that we have developed in domestic production recently? If we are entirely changing into green infrastructure, won't it be affected?
Yes, thank you, Amrita. I will
Well,
answer. Yeah. And any other questions? Okay, so let me answer these brilliant questions and we can wind up today's conversation. And it's a brilliant morning. I really enjoyed the questions asked by Nupur and Amrita, and your questions were broadly related to the economic growth process and the climate change commitments. And I can't agree with you more. That's what, I want to tell you first. Your points are very well taken. Now, let's unpack these concerns one by one. In this just transition towards a green infrastructure, Nupur mentioned that the returns are in future. So will it lead to a new inflation cycle? My answer is yes and no. In the sense, if you are focusing on the growth recovery process through the capital infrastructure investment, of course, the long term, the returns are long term and you need to wait for that. But if you're focusing on the cyclicality aspects in order to get the immediate benefits of the growth recovery process, you have many structural concerns in the economy, then you will not be able to get the growth recovery process all right if the policy narratives are just focusing on the cyclicality. So long term structural reforms are very crucial. Long-term capital formation in the economy, the policies related to that is very crucial. So even if we have high fiscal deficit or high debt, we are substantiating that with focusing on the gross capital formation. And a part of that, Amrita also mentioned in many countries, they are earmarking a part of that for the green infrastructure. Can we do that? Our country is in a mood to do that. But those narratives, it takes time for implementing in India, because we know that in this bargaining process, the just transition, if you're focusing on what the Western world wants, then we need to control the fossil fuel economy, and we need to grow out of this fossil fuel economy. And are we ready for that process? Because the energy poverty crisis is so huge. So we need time, we need to buy time in this just transition. So if it is immediate, of course, as you mentioned, it can affect the growth recovery process, because we need to tackle, it's a very dynamic process, and we need to tackle the energy poverty aspects. Now, the second point is, of course, in UK, there, as Nupur pointed out and Amrita pointed out, there are many solid reforms that has happened towards this renewable sources of energy. And these kind of policy announcements, if we have in India, what could be its repercussions on inflation? So right now, what India has done is, we have a green bonds policy, which was announced in the last fiscal. What we announced is, in the financing pattern of deficit, mostly through the public borrowings, that bond market operations. We are earmarking a certain part of this bond markets for the climate change commitments. And we call it as a thematic climate bonds or a green bonds. And we need to wait and see in the coming up, fiscal to understand the estimates related to this, whether we were able to do that effectively and how we interpret this green infrastructure projects in the economy. So in a way, the policy prescriptions and its outcome, it's too early to communicate, but we are in the mood of doing the greening of economy. Thank you so much.
Ma'am, also I have another question.
Go ahead.
Ma'am, in the recent lecture, I have heard one of Raghuram Rajan sir's lecture. In that, he had mentioned that India as a country should be focusing more on the service sector manufacturing, like rather than focusing on like manufacturing goods as such, because that will lead to a long-term effect on the growth of India. So, how far do you think that stands is true for Indian economy?
Thank you, Nupur. And this is closely connected to Amrita's question of how we, how our economy is a fast developing economy than even UK. Of course, we were always in the top five, and we are fast growing economy, and their service or manufacturing, that we need to take a call. Amrita mentioned that we have become this fast moving or fast developing economy because of the rise in the domestic production. That narrative is welcome, but I need to mention that protectionism, as I mentioned in my lecture also, protectionism through the tariff and non-tariff barriers, that can be little tricky, because world need to be open, and the fruits of an open economy, that can be very sustainable. And what we have seen right now, of course, there are many beautiful domestic production linked announcements are there with the current government, and the present government is focusing on many policies which are looking into the domestic production. There is no doubt about it. But what we need to understand is, in the long term, what has happened in the 1990s in terms of opening the economy, that has also helped the Indian economy to grow up to this level. That we must acknowledge, that it's a judicial combination of that open economy process that has happened through the globalization that has happened in the 1990s, that license Raj, the way we tackled, that was very crucial for the economy to grow, that new industrial policies that has happened in the 1990s. And of course, it's beautifully coupled with the domestic, that focus on the indigenous production. There, the narrative is, are we making our country ready to face the external competition, or are we closing down? So these are two different narratives. And I do go by the first narrative, make our country ready to face the competition from abroad. But if we close down, if we go back to autarky, then the cost will be huge. If we go back to autarky once again, which is what we have experienced prior to 1990s. So if we are, explaining that growth production, the domestic production going up, those, focusing on making the India ready to face the global competition, welcome. But autarky, there is a danger. So that's a way, I need to say. And service or manufacturing, we need to take a call, that judicious combination, because in certain parts of our economy in India, in certain states like in Kerala, it is a service-led growth. The manufacturing, there is no great presence of the industry, in Kerala. So that transition from agriculture direct to service, without a strong presence of manufacturing, do we want? And what are the benefits we are going to get from a huge transition from the agriculture directly to service sector? rather than, a huge presence of manufacturing, that could be little skewed. So manufacturing, the private corporate investment or the investor sentiments to be, protected, to have more private investment, that's very crucial, and India is doing those kinds of policies. So a huge presence of service sector, against a backdrop of digital infrastructure is welcome, but we cannot undermine the importance of the manufacturing sector, because if you go digital, if you're getting into the service mode, if you're doing the e-commerce, if you don't have anything to do the commerce in the manufacturing sector, then what exactly are we going to trade in the service sector or in the e-commerce sector or in the digital infrastructure? So we need to have a judicial combination, because if the manufacturing sector is not strong, if the digital economy is ready or the digital infrastructure is ready, what exactly are we going to trade in? So that's why, manufacturing sector also needs to be coupled with, the development in the service sector. Thank you.
Ma'am, I have a doubt.
Yes, who is that?
Ma'am, I'm Paridhi here.
Parity. Oh, go ahead. Go ahead. Yeah.
Ma'am, you spoke about inflationary pressure coming from the supply side shock. So, can you give us like more insights how monetary policy was used to tackle the supply side shock and the inflationary pressure?
Thank you. Parity, that's a big debate, when we started the inflation targeting framework in our country, two questions were significant that time. One is, what is the role of the central bank in controlling the supply side inflation shocks, just as you pointed out? Because inflation is not strictly a monetary phenomenon in the context of India. So will we be able to adjust the repo rates and control inflation? Because inflationary pressures can be from the supply side as well. So supply side right now, of course, the global chain, value chain, that disruptions, that those supply chain disruptions we need to tackle. Then, energy price volatility, and that's affecting us. Imported inflation component is there. Then food inflation, all these supply side shocks from the fuel, from the food, from the disruptions of the global value chains, how, RBI will be able to tackle this by adjusting the repo rate? That's a very brilliant question. And that time, the way we defended this question is, even the supply side shock inflation, that we can anchor effectively through the inflationary expectations channel. And in the last, my talk in last time, Nupur and I had a very healthy debate on that. You must be remembering that, but that's a way, we defend that. And using the empirical evidence, now the MPC members, they have highlighted, especially Ashima Goel, she highlighted that prior to the new monetary policy framework in India, the inflation was mounting. The CPI inflation was double digit. But after the new monetary policy framework, it's not double digit at all. And second, what she mentioned is that time CPI was mounting, WPI was under control. But now there is a huge divergence between the wholesale price inflation, index inflation, and CPI, consumer price inflation. So this divergence is also very important to look into, because otherwise, the entrepreneurs and the business sentiments, these are getting affected because our WPI inflation is mounting. So these questions needs to be tackled, and your concern is real. And, many economists, including Pilapre Balakrishnan, he has a paper recently, with Parameshwaran, looking into whether inflationary channel is working perfect in India. So the counter argument is that when there is less volatility in the energy prices globally, then we have been able to control the inflation using the inflationary expectation. So we bore the fruits of low inflation or low energy price volatility. But now the volatility in the energy price is so huge, and we are getting, we are at the receiving end of it, and we need to tackle this inflation which is mounting above the comfort zone. Now, to end, I will also add to this the debt crisis in the sense the public debt management is also done by RBI, but you can see the conflicting interest over there. For the public debt management, you need to keep the interest rates lower. Otherwise, the cost of borrowing of the government will go up. And we are now into this, reality of mounting inflation, mounting debt, mounting deficit. So that policy dilemma is also there. So the argument is that we need to take out that public debt management entirely from the purview of RBI so that RBI can focus on inflation targeting perfectly. But it's an empirical question whether the inflation targeting is able to anchor the inflationary expectations and reduce the output gaps, or is it leading to a new kind of low-level equilibrium of the growth process in the context of India? These are empirical questions. Thank you, Parithi.
Ma'am, I've got a question.
Yes, Sentinel. Okay, go ahead.
Ma'am, like, yes, ma'am. It is always like we hear it in news that whenever U.S. Federal Reserve hikes interest rate, even like it has an impact on Indian economy, and here the policies get affected by that. Why is that? Can you give more insights on that?
Sure, Sentinel. I mentioned that in the Jackson Hole meetings, we came to know the mood of US Fed Reserve. And of course, they are going to do a series of interest rate hikes. They are going to be on hawkish mode. So now your question is, how can it affect the emerging economies and the fragile economies like India? Of course, Brazil, Turkey, many countries, will be affected. And you may be remembering, Rikram Rajan mentioned that it's a kind of beggar thy neighbor kind of policies in the sense the US Fed Reserve focuses on, by mandate, they are not supposed to look into what is happening in the emerging economies. Their focus is on how they can tackle the overheating in the economy or how they can go back to the inflation containment to the 2% nominal anchor. These were the kind of questions they are grappling with and how they can reduce the balance sheet because they have done a lot of liquidity infusion into the economy. So in the FOMC meetings and in the Jackson Hole meeting, what we have seen is a narrative, but that's having an, unknowingly, I cannot say because, it has got its own repercussions in the emerging countries in the sense, as I mentioned earlier in my lecture also, in the foreign capital, a part of the portfolio capital that I mentioned as hot money, right? So, we are very happy with the mounting forex right now, but we need to understand how fickle is our forex reserves the moment US increase the interest rates, because the forex, the part of the forex which is hot money in nature will respond to high interest rates, and they will, there will be a capital flight if the interest rate go higher in US. So it is happening, and we are trying to grapple with that. And in 2013, when such situation was there, was a reality, how Central Bank of India try to control this free fall of rupee and how they try to control this capital flight. That time we entered into a capital control defense, but capital controls, we understood that it cannot be that effective. Then we intervened in the foreign exchange market a bit. And, then also we understood that if there is a free fall of rupee, we need to intervene. Otherwise, if the rupee is stabilizing on its own, the market, that is very crucial rather than RBI entering into the forex market, which gives a panic signal. So giving panic, that communication is very important from the RBI front. Toolkits is one thing, but how you communicate and how you take that, the moment or the timing of the policy communication, that also should not give a panic signal to the economy. So those were very important concerns. Then we understood that the capital control defense, the capital defense or intervening in the foreign exchange markets, these were not that great, but focusing on the macroeconomic fundamentals was very crucial, and interest rate defense was very crucial. So right now, what we are doing is interest rate defense to avoid, this mounting capital flight, responding to the rise in the interest rates in the US. We are doing an interest rate defense because hot money is based on the interest rate differentials. So I do think that the RBI is doing the right thing. Interest rate defense, that predominant narrative of RBI is well taken, and we are going to the hawkish mode, and fiscal policy is supporting the growth recovery process. So that's the way it is. We are doing an interest rate defense to tackle the mounting inflation, which is also coming from the global front, and also this rise in the interest rates that's happening in the US Fed Reserve. Okay, thank you, Senthil.
Ma'am, one last question, ma'am.
Parithi, go ahead.
Yes, ma'am. Ma'am, you spoke about the federal hike in interest rate by Federal Reserve, ma'am, and soon our US dollars will touch 80 rupees, ma'am. So, like the hike in interest rates by the US Federal Reserve, is it affecting the value of rupees with Indian dollars?
Thank you, Parati. That currency volatility is what I mentioned. But RBI, if they intervene in the market to stabilize the rupee, then that can give a panic signal. Unless there is a free fall, of course, as you mentioned, our rupee is getting affected. But, we cannot give a panic signal by interfering in that currency markets in a high frequency mode. So we have to wait and watch. If there is a free fall, then otherwise the rupee will stabilize on its own. So we have to wait and see. Now, in this time, our imports are costlier, but the exports are attractive. But at the same time, our export presence in the global market is less than 1%, So, we are unable to tap in the currency markets, what's happening right now, because our rupee is getting weak. So we are unable to tackle right now. Then another repercussion I can mention is that there are two kinds of bonds. One is rupee denominated market bond, and the other is dollar denominated bond. So that rupee denominated bond is, we call it as masala bond, just like the way China has dim sum bonds, that is the China's local currency based bonds. So that volatility with the bonds, because I think masala bonds have not done very well. We are focusing more on the dollar, based dominated bonds. So that external commercial borrowings will also get affected based on that segment of the dollar denominated bonds. There are issues, but my hunch is RBI will not get into an intervention mode unless there is a free fall of rupee, because that can give panic signals. So that, and even the interest rate, they are now front loading it. As I mentioned earlier in my talk, we are not, understood what is a terminal rate of interest, what's the upper bound, but they are front loading it to tackle all these crises. So the interest rate defense for the time being is the best, provided fiscal policy support the growth recovery process, because monetary policy is now focusing, relatively more on, the inflation containment. So there is a sequence, the reversal of sequence in their priority from the growth recovery process to the inflation and the capital flight. So let's wait and see. Unless there is a panic signal, we need not focus on too much high frequency intervention in the currency markets. Thank you, Parithi.
Thank you, Lekha ma'am. Thank you so much. You have taken
Thanks
much
a lot.
time in explaining all their doubts.
Thank you.
Thank you, ma'am. Ma'am, could you just, switch on your video for a while just to take a photo? Will it be possible, ma'am?
I'm just trying that. I asked for the access. One moment.
Just try. Students, can you please switch on your video? Yeah.
Yes.
Hi, ma'am. Student, I think you can say a hi to ma'am. She's here. Hi, please. Just a second. Thank you, ma'am. Thank you so much.
Thank you. Thank you so much. Thank you.
Thank you all. Aditi, can you propose your, yeah, Paridhi, sorry.
Thank you, ma'am, for giving a lecture on monetary policy. We were able to understand how climate change affects monetary policy. And also, thank you for all your insights given us about the supply shock and the currency inflation. Thank you, ma'am.
Thank you. Thank you so much. Wish you all the best. Thank you so much.
And thank you so much for joining, ma'am.
Thank you. Thank you.
Yeah, thank you, ma'am. Thank you.
We
so
will talk
much.
later. Yeah, yeah. Thank you so much. Okay, okay. Bye.
Students, you may leave the meeting. Thank you, ma'am. Thank you.